Join the club of the richest 1%. By employing the strategies in this video, you can become rich and established and join the club of the richest 1%.
The knowledge and strategies in this video are rooted in Jacob Nayman's extensive experience, distilling more than a quarter of a century in his role as a leading investment and economic advisor to some of the world's wealthiest. Infusing your life with the financial strategies outlined in this video will enable you to achieve the most important goal of the 21st century: financial independence.
The main assumption in asset allocation is that the investment in different assets results in diversification, which reduces the overall risk in your investment portfolio while maintaining the level of the return. Asset allocation can be exercised by implementing the rule of thirds. Warning: the securities mentioned here are only examples and do not represent suggestions or any recommendation for what you should or should not invest in. It is highly recommended that you build your private investment portfolio with the help of a licensed financial advisor. The rule of thirds. A wise investor will do the following: invest 1/3 in stocks and bonds. Invest 1/3 in real estate and commodities. Invest 1/3 in money and its equivalents. Each portfolio component, third, has a different role. The liquid third of the portfolio. The liquid component has two objectives. One, by maintaining high liquidity, you create a reality in which your portfolio exposure to the volatility/risk of the financial markets is reduced. Two, when the markets fall considerably, liquidity gives you the ability to exploit opportunities and buy securities at an attractive price using ETFs. Financial products that can be included in the liquid component of the portfolio: deposit accounts, short-term government bonds, money market funds, certificates of deposit, CDs, including foreign currency. The market third of the portfolio. The expectation is that the market component of your portfolio will produce returns/profits close to the market benchmark. Financial products that can be included in the market component of the portfolio: ETFs on sectors such as banks and technology, ETFs on major indexes such as the Nasdaq 100, S&P 500 index, Dow Jones, government bonds, medium term, with an average maturity of up to 5 years, corporate bonds with high ratings, A or higher, medium term, with an average maturity of up to 5 years. The alpha third of the portfolio. In the alpha component, you adjust your portfolio to include the indexes, assets, or sectors that are riskier and show the most potential for gains. The expectation is that the alpha component of your portfolio will outperform the market benchmark. Financial products that can be included in the alpha component of the portfolio: stocks, crypto, digital currency, corporate junk bonds with high yields, ETFs on REITs, commercial or residential real estate, convertible bonds, warrants, options, ETFs on commodities such as gold, petroleum, and agriculture products, ETFs on small cap stocks such as the Russell 2000 Index. The main points. A wise investor will do the following: invest 1/3 in stocks and bonds. Invest 1/3 in real estate and commodities. Invest 1/3 in money and its equivalents.
Is predicting your economic future a riddle wrapped in an enigma? Not quite. It's about creating it. Financial practices shared in the earlier segment, courtesy of financial expert Jacob Nayman, are your toolkit for securing that future. But here's the catch. Knowledge isn't the ultimate prize. It's action that truly counts. The upcoming segment aims to spark that drive, that motivation within you to implement these strategies. So take note and remember, in the grand chessboard of finance, it's not the player who knows the most moves, but the one who actually makes them, who wins. This video contains valuable information. Use it.
Dive right into the world of stock market investment, and one term you'll often encounter is alpha returns. What's that, you ask? Well, alpha returns are the excess returns on an investment relative to a benchmark index. They provide a measure of an investment's performance on a risk-adjusted basis. If you see a positive alpha of 1, that means the investment has beaten its benchmark index by 1%. But a negative alpha of 1 indicates an underperformance of 1%. Simply put, alpha is the value that a portfolio manager adds or subtracts from a fund's return. Now, why should alpha returns matter to you as an investor? What are the pluses you can draw from it? Well, for starters, alpha returns provide a yardstick to measure the performance of your investments against a market index or other broad benchmark. It's like a report card for your portfolio manager or advisor, showing how much value they've added. If the alpha is positive, it means that your investment has gained value, which is always a good sign. In essence, a high alpha could signify a successful investment strategy. But like all things in life, alpha returns come with their set of drawbacks. First off, alpha doesn't account for the risk associated with an investment. A high alpha might seem attractive, but it could be the result of high-risk strategies. Additionally, it's crucial to remember that past performance doesn't always predict future results. Just because a stock's alpha was high in the past doesn't mean it will continue to be. So while alpha can be a handy tool, it should not be the sole determinant in your investment decisions. Navigating the stock market can be a complex endeavor, but tools like alpha returns can help simplify the process. Remember, understanding alpha returns is just one piece of the puzzle, a vital cog in the grand machinery of stock market investment. It's crucial to continue broadening your knowledge base, diving deeper into the financial world. Keep up your education, keep up your research, because in the world of investment, knowledge truly is power. Keep learning, keep investing, and you might just find your path to financial success.